In this video, I'm going to cover the question of how much can you make? What are the expected returns? So it's a common question that we get a lot in the program. And I'm going to answer it in two different ways. Firstly, what type of returns can you generate with this type of algo trading? Well, if you came to me right now and said, I want to generate 100% per month, so double your account every single month, you can create an algorithm that does that. You can create a portfolio of algorithms that does 100% per month. However, that's going to be extremely risky. And the likelihood that you'll blow your account is very, very certain. So you can create whatever you want to create because you dictate the terms. You dictate the return to drawdown ratio. You dictate how many strategies that you're going to create within your portfolio. So you can create whatever you want to create. And everyone has different risk tolerances. Everyone has different experience. So it's completely up to you and it's subjective. But to answer your question as a blanket statement, Fabian, the coaching team, we can create algorithms that comfortably do 5% per month without taking on too much exposure. That's my personal risk tolerance. That's not what I'm suggesting to anyone. That's just my personal risk tolerance, which means you're within line within prop firm rules. The drawdown's minimal. You can trade your own accounts. You can trade prop firm accounts. That's my personal experience. So if you look at most of my portfolios, they average around about the 4-5% per month mark. Now, you can push the boundaries to go to 8% per month, yes. But in my opinion, you'll be taking on too much exposure to do so because there's a balancing act between how much drawdown or relative equity drawdown you're willing to take on to realize net gain, which basically means how much drawdown are you willing to go into before you see a net positive return. So I always tell people as a blanket answer, the 4-5% per month is what most people decide to shoot for because it's modest. And the way that you make money long-term in trading is to stay in the game long enough. So those of you who are of the same mindset and risk parameters as myself, you should be able to create something pretty standard. So how do you actually go about achieving that? Well, most people in the algo trading space, or most people in the trading space altogether, they have a strategy. They have a strategy on a certain asset, or they have a certain breakout or trend strategy that has all their eggs in one basket. The way that we like to build is to have multiple different assets from different asset classes and different strategies and be long and short. So we have a different mix of trading currency, precious metals, and some indexes. And then within that, we have long and short. So you're both sides of the market. If it's a sell-off day, you'll lose on the downside, but you'll win on the long side. And then within that, we have different strategies in and of themselves. So you can have breakout strategies, you can have trend following strategies, you can have mean reversion strategies, you can have seasonal strategies. So within the framework of the different strategies you can create, you also have different archetypes of strategies, so different strategy types. So it's another common question we get is what is the actual strategy that you're creating? Well, you're not creating a singular strategy because certain assets are more suited towards trend. Certain assets are more suited toward mean reversion. Certain assets are more suited towards daily breakouts on the opening range bars or candles. So for example, if you trade the German DAX, is one of my favorite instruments, that tends to go on long trending runs, sometimes for months. So it makes no sense on an asset like that to do a mean reversion strategy or to have your profit targets fixed, like a fixed percentage or a fixed pip. It makes no sense, in my opinion, because you're going to miss out a large potential opportunity. If you have a strategy on the Euro CHF, which is very choppy, it makes no sense to deploy a trend-based strategy because it reverts to the mean so many, many times. So depending on what your portfolio mix is going to be, will determine what type of strategy you build. Now, within the program, we have different strategy templates for trending markets, for ranging markets, etc. So I always shoot for low, modest risk. I like to diversify a lot within asset classes themselves and the types of strategies that we create. And in my opinion, there's never any point trying to go for systems that have huge monthly returns because you're never going to stick with that long term. It's never going to work long term, ever. You see a lot of people online talk about doubling their account every month, flipping their account. That sort of stuff's garbage. It's not finance. It's just gambling. So the way to stick in the game long term, what we found is one, diversity, to spread your risk, and two, to go for modesty, but go for consistency. And the way that we build that is through asset diversification, different strategy types, and a few other secret sauce that we have in the program. So I hope that answers the question, and let's get on to the next video.